Dissecting journal entries using example, Part 2. On 30th April, office rent of $5,000 remained unpaid. On 10th May, a debtor, Ravi, became insolvent, and $2,000 due from him is now written off as bad debt. On 20th May, Anu received $4,000 as advance rent for June. On 25th May, insurance of $6,000 was paid to cover the next 6 months. On 1st January 2026, $20,000 was borrowed from a bank at 10% interest per annum, with interest payable monthly. Record the journal entry. Starting with the first entry type, that is outstanding expense liability. On 30th April, office rent remained unpaid. We have the following journal entry. The accounts involved are rent account and outstanding rent account. According to the accrual basis of accounting, expenses should be recognized when they are incurred, regardless of when cash is paid. Since the office space was presumably used during April, the rent expense of $5,000 has been incurred for that month. Expenses increase with a debit. Since the rent has not been paid by the end of April, the business has an obligation, or a liability, to pay this amount in the future. This liability account represents the amount owed for rent. An increase in liabilities is recorded as a credit. Our next journal entry type is bad debts. Our debtor, Ravi, became insolvent. Meaning, we will not receive the amount for the goods that we had sold to Ravi on credit. Following is the journal entry. The accounts involved in this transaction are bad debts account and Ravi's account. When a debt is confirmed to be uncollectible, it becomes an expense or loss for the business. Expenses are recorded with a debit. This recognizes the financial loss incurred because the receivable will not be converted into cash. The amount receivable from Ravi is no longer an asset as it cannot be collected. To remove this amount from the company's books and reduce the total accounts receivable balance, Ravi's debtor account is credited. A credit decreases an asset account, like accounts receivable. Our next transaction is prepaid expenses. Anu has paid some amount towards insurance. The insurance has been paid 6 months in advance. Following is the journal entry. The accounts involved are prepaid insurance and cash account. Since the insurance payment covers a future period, it represents a prepayment. This prepayment is an asset because it provides a future economic benefit. Assets increase with a debit. This amount will be gradually transferred to insurance expense over the 6-month coverage period through adjusting entries. Cash was paid out by the business, resulting in a decrease in the cash asset. A decrease in an asset is recorded as a credit. The next journal entry that we need to tackle is adjusting entry. Do you remember this entry from Part 1, where Anu had received $4,000 in advance for rent? At that time we had created an entry on 20th May for rent received in advance. Since the advance was for June 2025, the income is earned during June. The adjusting journal entry to recognize this income would typically be made at the end of June. Following is the journal entry. The accounts involved in this entry are rent received in advance and rent income. As the month of June has passed, the business has fulfilled its obligation related to the advance payment. Therefore, the liability decreases. A decrease in a liability account is recorded as a debit. The rent for June has now been earned by the business. According to the accrual principle, revenue is recognized when it is earned. Revenue increases equity and is recorded as a credit. Our next and final entry is loan taken with interest. So, Anu borrowed some amount from the bank at an interest that is payable monthly. Note that we are required to record the journal entry for both the principal and interest amounts. Following is the journal entry for principal amount. The accounts involved are the banks and the bank loan. The business received the funds directly into its bank account from the loan. This increases the business's assets. An increase in assets is recorded as a debit. Taking a loan creates an obligation for the business to repay the borrowed amount in the future. An increase in liabilities is recorded as a credit. As for the interest amount entry, we will have to calculate the interest that is payable monthly. Following is the journal entry. The accounts involved in this transaction are interest account and the bank account. The cost incurred for using the borrowed funds during January is an expense to the business. Expenses increase with a debit. The interest was paid, presumably from the business's bank account or cash, which reduces the business's assets. A decrease in assets is recorded as a credit.